very good afternoon, everyone. I'm joined by an esteemed set of panelists today, and we have a lot of knowledge wealth in the room, and we will be drawing upon all of them to share their insights. But just to give a quick context, to achieve net zero low carbon pathway, while technology and technological developments play a very crucial role, but I think it's equally important to understand how this will be funded, because not all the technologies are mature technologies and are less riskier, but at the same time, with the innovations that are happening with the existing technologies, and more importantly, the new set of technologies that are required for decarbonizing all the sectors, not only power, there is a lot more risk. So how do we ensure the funding is coming for the newer technologies, importantly, and also for the players like MSMEs who does not have that kind of a credit history. So I think these are some of the issues that we are facing. Also, it's not only about the technologies, but when we talk about clean energy pathway, we also need to look at how these renewable energies are better integrated. So there's a lot of investments also needed for infrastructure expansions, and also across the value chain. So downstream to the solar modules or electrolyzers, and even to critical minerals now. In order to ensure the investment flows happen, we also need a conducive policy environment. So there are questions regarding taxonomy, ESG disclosures, and then also, what kind of government support that can come in, especially for the newer technologies in terms of fiscal support, taxation. What role can MDBs play in terms of bringing the catalytic capital that can spur more and more investments by the private players? So there's a lot to unfold, and we have a very short time. And without wasting much time, I will now draw upon, as I said, the experience of the experts that have joined me today in this session. I will try and pick up one or two questions in the end if the time permits. Otherwise, please do feel free to reach out to all these panelists during these breaks. And I'm sure I've taken the liberty on their behalf that they'll be available to answer any of your queries if we don't get time at the end, since we are running a bit late in terms of our schedule. So with that, I will start with Mr. Kumar, with you first. In terms of what do you think are the broad implications of the climate change on the Indian financial sector? And what are the ways that are required to steer more and more investments coming on technologies that can really address some of these climate change issues? Mr. Pratap.
Thank you. Thank you. We all know that India is quite vulnerable to climate change. You just have to step outside the hotel to realize what it is like. India stands 7th in the Global Climate Risk Index. Quite vulnerable. India is trying to push renewable energy as a way to become more climate resilient, low carbon, and we already heard in the first session about the targets that we have by 2030, 500 gigawatts of non-fossil fuel energy, and we are currently at 187 gigawatts. So 43% already there in terms of the current installed capacity. So our current installed capacity is 434 gigawatts across sources, out of which 187 is renewable, including large hydro, which comes to 43%. Now, because of this vulnerability, the financial system is impacted in terms of the non-performing assets that would happen. As you would recall, right now in terms of gross non-performing assets, we are quite comfortable. But just 6 years back, the gross non-performing assets of the banking sector were in double digits, about 11%, and the infrastructure portfolio of these banks, the scheduled commercial banks, the non-performing assets were 22%. Right now, we are at 3.2% overall. So our financial system, to that extent, has become quite strong. But given the current good state of our financial systems as far as non-performing assets are concerned, the regulators, including the Reserve Bank of India and SEBI, have been talking about a lot of changes. You would be aware, since you're active in the infrastructure field, on May 3rd of this year, the RBI came up with draft prudential norms for under construction infrastructure projects, where they're proposing to raise the capital which is set aside to 5% from 0.4%. This will make financing costlier, and the thinking process is that given the current sanguine state of the financial system, it would not disrupt too much while ensure for the future. Part of the reason is also climate change and to make it more climate resilient. RBI recently came out with a discussion paper where they found that 3 industries specifically accounting for a quarter of the total investment in the industrial sector, specifically energy, chemicals, and automobiles. They account for 24% of the total financing from the commercial banks to the industrial sector. And they are prone to becoming NPAs if we don't do enough. So they also came out with the draft disclosure framework on climate-related financial risks. This was in February of 2024, where they wanted the financial institutions to come out with a way, with a strategy to become more climate resilient, come out with the metrics that they would use for mitigating risk coming from the climate segment. Similarly, the stock market regulator, SEBI, we heard in the first session, the top 1,000 companies have been asked to disclose their climate credentials as per the market capitalization, the top 1,000 companies, and that's mandatory on them. Increasing importance of ESG, we know that the credit rating agencies like India Rating are increasingly using ESG in their metrics, and the business behavior, given that all this is happening in the corporate sector, the business behavior is also changing. NTPC, the largest thermal generator of this country, 76 gigawatts we just saw, 76 gigawatts of installed capacity, out of which 66 or maybe more, 68 is coal and gas. There also they have incorporated a renewable energy company in 2020, and they plan to have 62 gigawatts of renewable energy by 2032 as a method of survival in this changing world. Coal India Limited, the company which is the largest coal producer in the world, it is in fact contracted out a project of 3 gigawatts in Rajasthan to generate solar power. So all these changes are taking place in terms of the financial system and should help to make our financial system more climate resilient. Thank you.
Thank you. I think you have very swiftly laid out some of these recent initiatives taken by RBI and SEBI And some of it, while might increase the cost, but others are more to attract more and more investment and making, ensuring that the regulation support access to some of these sustainable finance going forward. Mr. Sinha, coming to you now, Mr. Kumar just laid out some of these regulations which have just been recently announced. So, is the current regulatory environment conducive enough for banks and NBFCs to invest in these, the existing as well as new technologies, climate resilient technologies? As well as from your perspective, what kind of challenges do you face when you do this project financing? And what, according to you, are some of the recommendations to overcome those challenges?
Well, thank you. There are a lot of challenges in the sector when we work on these projects. In fact, the regulatory frameworks are there, and rather they are helping us in working out the financing to such projects. The viable projects, we have to work out that the project is a viable project, generate enough revenue to repay the loans, and the location and other factors, the preparedness of the borrower, all those things we look into it when we work on the project. But as an industry, I see when we talk of around, say, 500 gigawatt, that what we have been talking since morning, and everywhere it is being talked that 500 gigawatt by 2030. I look at it in a different way, that to achieve that, we have to make an investment of around more than $200 billion into the Indian system. Investment of $200 billion is a very, very challenging task. Funding, PFC no doubt can work on it, and we are one of the leader in such field. We are the largest NBFC in the country. We have been supporting power sector in a big way. For your information, we are the largest lender in the renewable sector. We have an exposure of around more than 60,000 crores in the renewable sector. But going forward, what we see that around see the power supply scenario of the country is changing day by day. What we see during this season, the demand has gone up to 250 gigawatt in our system. And with that, wherein solar itself contributed around 40,000 gigawatt, which is around, say, 20% or so. And the most challenging part is that during the solar hour, we have solar power, which is 20% of our demand, and non-solar hour, this entire solar power becomes zero. So, to meet that additional 40 gigawatt of power during non-solar power is becoming a challenge for our system. And that is why we have been working on the thermal capacities are required in our system presently, and those thermal capacities, they come in the peaking hour, because hydel is seasonal, wind is also seasonal, and nuclear, there are limitations in the nuclear power in our system. So the thermal capacity is something which is taking care of our demand during non-solar hours. So when we talk of net zero, it is something which that we'll have to look into it, and it will take some time to stabilize the system, because unless we have a storage system in place, a robust solar system like pump storage or our batteries and all, we can't work without thermal capacities during the non-solar hours. So there has been a challenge, and we have been working on it, and fortunately the regulators are also there. They have been, as Mr. Kumar just said, that from time to time the revised guidelines keeps coming, and we have been aligning our lending requirements along as per the regulatory guidelines that keeps coming to the system. And with the new guidelines that has come up, the NPA has really reduced over the period. And there has been learning for not only for the for us also as a lending institutes to mitigate the risk in a better way, what we have been doing earlier. And fortunately now we have been doing that, and that is why the NPAs have come down. That's it.
Thank you, Mr. Sinha. Shailesh, or maybe before I come to Shailesh, Sandeep, I wanted from the text perspective, like while till 2030, we still have as part of our NDCs that we want to achieve 50% of capacity by non-fossil fuel sources, and we have done a demarcation of what it translates to in terms of solar, wind, pumped hydro. But beyond 2030, I think there's less clarity. While we do have a 2070 net zero goal, but what it means in terms of technologies, we are not very sure of in future. So at UNIDO, you have been supporting a lot of tech startups, which are not yet achieved maturity in terms of technologies, but also struggling to attract mainstream capital. We have seen in 2023, technology startups have received the third most quantum of funding that was available. And within that, even largely it was steered towards transport sector rather than any other sector. And we have seen a lot of venture capitalists and other forms of financiers interested in the tech environment. But where do you see are the investment opportunities in this space? And secondly, currently what we have seen the trends that, especially in India, the low investment in the R&D of these technologies. Will this act as a bottleneck for the climate tech startup going forward?
Yeah, thank you, Vibhuti. Before we get to the detailed answer, I'll take a step back and brief you. I represent the United Nations Industrial Development Organization, which is one of the specialized agencies of the UN working on the industrial development. It is considered amongst the youngest UN organization that was set up in 1966. And since then, it has been working in India also with Ministry of Commerce, DPIIT. One of the flagship programs UNIDO had in the last 10 years on promoting clean technology innovation. And that has been done worldwide by UNIDO, starting with about 10 countries, India being one of them. And that program still continues, covering 16 countries, pushing on the same agenda on that innovation should be is the next frontier that can bring up answers for climate change mitigation. And India, we went a step further with this program where in the last 7 years since the program, which is being implemented with the government counterpart under Ministry of Power, Bureau of Energy Efficiency. There have been about 140 climate tech startups have been supported in various ways in business mentoring and financial support in terms of supporting their technologies for validation. And we took it to the industrial sectors because these were the ones that is needed by the industrial sector to validate how these would perform and what kind of energy saving, emission reduction results it would provide. And we got fantastic results on these. We have actually provided more than $4 million of funding directly in the hands of these startups. Many of them are bootstrapped to take their innovation out in the market from the labs. And many of them have been also from IIT, and this funding has helped them to move out of the IIT and establish themselves as a for-profit entity and started scaling up. So gradually these solutions are coming in the market, but what is really needed is to a financial support mechanism to scale up and accelerate to penetrate these innovative technologies coming out in the market, so that there's a greater adoption is there by the end user, primarily the industry. And we had a whole lot of solutions, few of them for the large industries, majority of them for MSME. But interestingly, we came across solutions for the food supply chain, dairy supply chain, as well as agriculture. So that led us to believe that when we are looking at a larger goal of decarbonization, then besides the industries and the automotive sector, many others, almost all the sector would need solutions for decarbonization. It's just not because they are not within the radar, we don't talk about them, but energy is used in one way or the other in every other sector, and we need solutions, and many of the startup are bringing these solutions. Now the issue is with the startup and the funding support. Initially when we started there was hardly any but financial support, but of late since 2022 after the Glasgow event, a lot of venture capital have emerged, which is looking at clean tech or climate tech solutions. However, there's a mismatch on their expectation, because a typical investor would still expect climate tech solutions to give you 5x or 6x revenue improvement, whereas we are looking at these solutions which is working in B2B segment, and there the expectation results are slightly different. Therefore, the support is needed for these startup in terms of financing. There is requirement of government to step in, because they are serving a very important goal. I mean, coming out with a solution which goes beyond the countries, the NDC 2030 target. It goes to maybe beyond 2030, because many of these innovations that are in the nascent stage commercial, but they need funding support to grow, would likely come in the mainstream in the next decade, as we talk about. And industries, because they have some regulatory target under the Government of India's PAT program, Perform, Achieve and Trade, they are coming to a stage where they have started asking that we are reaching the threshold of making investment on energy saving. We need a kind of next generation solution. So there is a need for the industry and academia to work together to start finding out solutions that can be commercialized and scale up. So the intervention is needed both on the debt financing as well as equity financing by the government, and which can work with some of these venture capital. Oftentimes we have seen the startups struggle with working capital because they have got enough orders, but then they are unable to raise shore of funding to service many of these orders. So solutions are coming, but I think what is needed is to few key people, stakeholders, to huddle together and do brainstorming on how do we support these startups, so that we have both approach on the supply side and on the energy consumption side, that many of the innovations come to the forefront and start helping to decarbonize and reduce the energy consumption in many of the sectors.
Thanks. Shailesh, you just heard Sandeep highlighting some of the issues. What has your experience been in funding some of these climate tech startups and the kind of challenges they face, specifically in terms of increasing the scalability? And we know that, getting few hundred lakhs or crores just for testing the technology is still not a problem, but the scalability is a big, big challenge.
Thanks for having me over. So just to give you a background, I'm Shailesh. We run a fund, a small fund called Climate Angels Fund, much smaller than the people in DICE. This fund is around 500 crore, and this 500 crore is not what you call government money or any institution money. It's majority of friends and family money. Almost 20% is our own money. Out of this 500 crores, so far we have done around 18 investments, deployed close to around 80 crores, and we are already at 5 to X, 8x returns we have got into initial 2 investments. They are hardcore climate focused investments that we do. So I do not agree that the returns are very less. I think climate is a very huge opportunity because it is an industrial 5.0. Because the way we have been producing electricity, the way we are doing transportation, the way we are doing what you call food, everything has been done in a world which was 200 years back. That what has changed, and we need a new technology, and there's a great opportunity. Other than this fund, I also run an accelerator program for whole Asia. We run with UN, UNEP, and so far we have handled more than 1,000 startups, and our startups so far have raised more than $450 million. And the returns for the initial investors have been more than 30 or 50x, right? So it's a myth that there is no money, there are no venture returns. It is there. In fact, it is far bigger than what you'll see in consumer tech. So I don't think that is a challenge. The challenge somewhere else. As an investor, I'm happy to take the market risk. I'm happy to take the technology risk. Execution risk. What I'm not willing to take is technology risk, like R&D gap. Unfortunately, the India that R&D window does not exist. The quality of the Indian academia, you all know, right, is not even bad, it's pathetic. The startup which we need to do those access labs and things doesn't exist. So we have to look at what the DARPA does in US, what Israel does, right? We need to create a framework where a lot more capital from the private, not from the government, should come into R&D of the startup, not from the incumbents. We have seen that it is always the new companies which disrupt the market. The new reusable rocket didn't come from NASA, it came from SpaceX, right? So you have to create new startups, new technologies which go to these new crazy people who disrupt the world. And for that, we have to create a policy framework where the companies, large companies, rather than doing those massive buybacks, should start investing some part of it into these startups, right? Otherwise, it won't change. And the attitude of every large enterprises towards this has to change, because SpaceX is today not because of tech is there, because NASA gave it multi-year contracts, very large contracts they gave it. I do not expect that to happen with DRDO. Is DRDO giving the private sector such a large contracts? Generally, they end up giving to those same large companies. So we have to create a what you call an environment of risk. Then there's another point, like the money you need, right? When we talk of climate, people come with $1 billion, $1 trillion, lot of figures, and I think that is again a kind of misnomer. If you look at, let us step back to 1980s, and if somebody come and tell you that we need to create a what you call telephone in every house, and people used to come with those multi-exchanges, copper wire, landline, everything else. In 1/10 of the money, the whole country got mobile. And nobody lost money. There was no investment. Everybody made money. Telecom companies made tons of money. Second thing was banking. Whenever you talked of universal banking, people always talked of setting rural banking, sending ATM to the villages. All these things happened. We have got the whole country digitalized, where the companies like Paytm, PhonePe, and others have digitalized the whole country at less than $3 billion. While everybody was talking of $100 of billion to make universal banking in every home, and today at less than $3 billion, everybody has a bank account in their mobile. And has it been lost money? No. It has created overall net positive. So I think this is an opportunity, and I'm very excited about it.
Great. Good to know some optimism here. But Mr. Sharma, coming to you now, while there has been a lot of investments into large-scale renewable energy deployment, and India is one of the faster adopter of renewable energy, and we've seen huge investments coming to India as well. But there are other sectors like compressed biogas, which are still not receiving the attention they deserve. And at the same time, we are seeing some interest, but the government has come up, say, for example, in the 2023 budget, with setting up of 500 such plants and giving the financial support of 10,000 odd crores. Do you think such schemes or such government support program will really be instrumental in driving more investments into the CBG space specifically? And also, if we are to explore, if not just the government support, what are the market instruments, a green credit program, can it really help in infusing more and more capital into the CBG?
Thank you, Vibhuti. We are running out of time for session, and in fact for humanity also. So thank you, Sudhir, for organizing Net Zero Conclave and inviting all of us, particularly inviting me for this session where experts are there. And for me, green finance is Hare note, nothing beyond that. So I'm not very much expert on the subject, but what I would like to share with the audience and with the panel is, Vibhuti, that quite often what we talk when we talk about finance, and that is true for green finance also, as other panelists have talked about, is outflows. That how outflows will be there, that investment on capex and opex, that from where it will come. But that is not enough. In fact, until unless we talk about inflows also, businesses will not be successful. And we have seen that for many sectors. We have recent example of ISOs, which received millions of dollars of money as investment, and then it failed because no one thought about inflows from where money will come for running the business or sustaining the business. So what I want to share is that what ecosystem is being created in India is comprehensive. It is end to end. And I will talk about each part of that one by one, although time is not much. But to begin with, government has many schemes, some of which you referred from the last year's budget, and then we have Satat and priority lending and so many things about how to set up the plants in CBG sector. So there are many schemes from where people can get funds to set up the plants. But more important is that what after that, when plant is set up. So government is also creating demand for their products in form of mandates. That mandates are there in case of CBG. Current year it is voluntary. Next year 1, 2, 4 and then 5%. So that will create the kind of demand so that these plants which will come up with the government funding or the private funding from banking, so many other sources are there, that they become feasible, they become viable. So they have a market for that. But at the same time, I will be short in not detailing the things. Then issue and we are in learning phase. So the issue came up that how to collect the feedstock. So government has come up last year in that at the time of that budget only, and after that there is a separate funding for CBG plants and other institutions to collect that crop waste and so many other raw stocks, feed stocks. So that kind of funding is also taking place. Then in case of CBG, there was issue that how to connect it to the market. That it has to be connected to the network of CNG so that it can get blended or it can reach the market. So another scheme has come up where pipeline setting up is getting supported by the government funding. And as far as the last part of your question is concerned, it is very recent, and since currently the blending is voluntary, it will get affected from the next year. The problem is that gas can't be transported without pipelines, and mandate is for everyone. So government has come up with a product which is green or renewable gas certificates, RGCs, and those will be available in the market for those who are not able to meet the demand or blending demand. So they can buy those green certificates from the market. And incidentally, why I accepted this invitation to be on this panel, that our organization, which is PPAC, has been made the registry for that. So we will be managing those certificates from end to end, from how they get created, the gas is produced, how many certificates are attached to them, and then how they get consumed. They get consumed through trading of the certificates, or buying of those certificates in another means, or green gas buying. So all those things are to be managed by PPAC, and that is very promising aspect of business, that these green certificates will bring additional revenue for any CBG manufacturer or plant. They can sell their gas, and then they can sell all their certificates also. So this is a additional revenue source for them. So what I believe, as I said in the beginning, is that any financing system has to be end to end. And I believe that until unless we create the kind of system where investment takes place, and then also the investment is returned in shape of market and good pricing. In fact, when I talk of pricing, in a scheme which is called Satat, there is a set pricing. In fact, the gas is distributed through various oil and gas companies, and they assure the gas manufacturer, CBG manufacturer, through LOI, that we will buy your gas at a set price. So that kind of mechanisms are there in the market, and I am sure that CBG space is growing very fast. So many big corporates have come, and in next 1 or 2 years we will see so many gas plants coming up, and gas being blended in the CNG. Thank you.
Thank you. I'm just going to use another 2-3 minutes. I'll come back to you, Mr. Sinha, again. coming back to large-scale RE adoption or deployment, and PFC has been one of the biggest lender lately to the RE sector, but you have also raised green bonds to fund RE projects. Do you think green bond market can be a viable option going forward for the likes of banks and NBFCs as well to address the asset liability mismatch that we currently have?
Yeah, I look forward to this green bond market. In fact, we do have raised a green bond. Rather, we were one of the first in 2017. We raised around $400 green bond. And then in 21 September, we raised around €300 green bond. But you look at this green bond, in fact, in the Indian market, whatever the funds that has been raised through bond, green bond is just 1%, less than 1% of it. So a lot of things needs to be done to take this green bond further. In fact, regulatory things are to be in place to take green bond, make it more attractive. In fact, there is more harmonization in the policies are required, not only in the India context, in the international context also. So we need to have a uniform policies and transparent things so that it is, we do have a different tax structure and other countries have different tax structure. What we have seen that the green bonds that has been raised was was almost on the same footing as what we could raise from the domestic market. But the cost of raising a green bond was higher than what is there in the domestic market. So one would prefer going for a domestic market bonds rather than going for a green bond. That is why you see, as I said, that around it's just 1% of the bond that has been raised. So a lot of things needs to be worked on this. The information assimilation is also required, and funding through green bond. See, with the green bond, we can't the amount of fund that is required for this renewable sector is something that is huge. And what we are doing that is that we are blending it with other instruments to fund the project, because the asset liability mismatch is always there. The green bonds are for 5 years to 7 to 10 years, and the assets that we have been funding, which has been bidded through SECI and all, do have a tenure of around 25 years PPA, and the tariff is too low, around 2.5 to 3 rupees. And when we work on those projects, funding needs to be for a longer tenure, around 14 years, 15 years, or maybe 17, 18 years. Then only the projects are made viable. So we have to structure the debt in such a way that the repayments are smooth, and we don't face any issues in the repayment of loan, and the borrower also don't face any stress in repaying our loan. So there is an asset liability mismatch. It can be taken care by blending it with the domestic bonds that we have been raising and we have been working on. So that way it is being worked out, asset liability.
Great. Mr. Kumar, one last question to you before we close this session. We have been talking about the roles of banks, financial institutions, all these other market-based instruments, whether it's green certificates, but public finance still has a big role to play. We are increasingly seeing in the markets of US with IRA and EU Green Deal, there are billions of dollars being invested into the clean energy ecosystem in those respective countries. Now, India has very competing requirements as a developing nation, and so how do you think the government needs to prioritize its public spending on energy versus other competing needs as a developing nation?
Right, as you said, there's a huge resource crunch. It has to be allocated very wisely, And I think there's the viability gap funding that, renewable energy can get from the Ministry of Finance and the Government of India. The limit is 20% of the total project cost, and that way you access a much larger pool of private investment. Similarly, government has tried to reduce the project development risk through SECI. The solar parks which are being created, they have land which is available for the private sector, and then you have the transmission facility. Both these are very crucial and they help in setting up of private projects. Similarly, the PPAs that are being entered into by the private sector, the SECI is a much more reliable and a better customer and than say financially weak discoms. So your off-taker risk, the commercial risk, the demand risk is taken care of, and the private sector comes in by setting up these plants, and the public sector creates the enabling environment. I think that's good use of money, and both multinational capital in the renewable energy sector and public finances are working in tandem to make renewable energy more popular in this country.
Thank you so much. With this, we'll bring the session to a close. Okay, that was also a good signal for me to end the session. Thank you all the panelists for an enriching discussion. Can we have a big round of applause for them? Thank you.
Thank you, ma'am. In case the audience has question, we can take one very brief question from the audience if you raise your hand. So we'll just pass on the mic to you. Request you to please introduce yourself and keep the question brief. Thank you.
Good afternoon, everybody. I'm V.K. Srivastav, Head Energy Services, Seva. My question with the last banker gentleman, sorry I'm missing your name. Yeah, what I heard that all the certificates are being merged with the carbon certificate, like REC and RPO and all that. Now this renewable gas certificate, what you spoke, shall remain separate, number one. And number two, that biogas plants, if the oil distribution company pipeline is say 5 kilometers away, who bears the cost of last mile connectivity? Thank you.
The first part is that these certificates are mechanism for meeting the blending mandate which is coming up from next year. And it is not linked to carbon credit certificates or any other certificate. It is independent kind of certificate, which is basically to meet the blending. As far as second part is concerned, it is naturally the entity which is setting up the plant or the consumer company. But as I said that there, last year government has come up with a scheme where even that pipeline laying is getting funded through that mechanism, where it gets subsidized kind of sort.